Hello, everyone, and welcome to Edison TV. My name is Jyoti Prakash, and I'm a healthcare analyst here at the Edison Group. We are joined today by Dr. Andreas Wicki, the CEO of HBM Healthcare Investments, a Swiss investment trust with a diversified portfolio of investments. Welcome, Andreas.
Welcome. Thanks for having me.
So to kick off, HBM Healthcare Investments is differentiated from many of its peers with its significant private equity focus and investments in listed small cap businesses. Can you elaborate on the rationale for this strategy and how that has helped manage volatility given the wider industry drawdown in the past couple of years?
Yes, we started with this strategy, from the very beginning 23 years ago, and we were focused on private equity. But if you do pure private equity, you often have the problem that if companies go public, and most companies, will go public if successful because you can't sell the majority of your holdings, then you need to benefit from the public markets in the sense maybe you want to add to it, maybe you want to look at other assets. So it's very, very positive for investors to have a private equity that has allowance to go all the way to public equity. What's also important for investors to know, if you have a good public equity franchise, you have to set up with the brokers, with the traders, and so you can also optimize your return, by selling at the right times or by selling at opportune times.
And HBM is structured as a permanent capital structure. Can you explain how that works when compared to the traditional limited partnership funds and other open-ended structures, particularly in this healthcare space?
Absolutely. The traditional LP structure means that you have a life of 7 to maybe 10 years with your investments. So let's say you make an investment in year 4 because you have an investment period that is maybe 1 to 4 years. That means your investments might actually not be mature by the time your fund already closes. Some of our most, profitable investments that we have done had very long holdings because you might start with something young, something very innovative. You back it through several rounds on the private side, then it might turn public and really still grow. And you can have, very big successes late in life, meaning even after 10 years of investment. In a normal traditional fund, you would be out of that investment. With a closed-end structure like we have, you can actually still remain, and you choose when you want to harvest your portfolio versus the LP structure where you often are forced to at least look for an exit earlier. What's also good is in a open-ended structure, your investors might actually pull the money in times that are the worst for the portfolio manager because you have maybe a downturn in the stock market, and so investors want to bring money home, and you hurt your investors with a long-term perspective by selling in such times because the prices might be the lowest for a long time to see. And so with a permanent capital structure closed, then your capital is actually secure in such downturns, and you can take the opposite approach. You can actually, if you're prudent, you can invest in down cycles versus in open structures where you have to divest and you actually punch, on the negative side. So we are very fortunate to have such a closed-end structure. The shareholders, of course, if they're really worried, they can try to get out, oftentimes, of course, with discounts to the net asset value. But you can sell shares into other hands every day, so you have a liquidity, which also you don't have with, for example, a LP structure. You don't have liquidity unless the manager sells holdings and then returns capital to you. So I think from a overall look, this closed-end structure as we have it is really beneficial for the long-term holders, as we can also make additional returns through, for example, buying back shares if they're on a very low net asset value share price level.
Okay, that's very interesting. So moving on to the next one, 1/3 of your assets are currently invested in Asia, which is significant given your otherwise global portfolio. What are the key growth drivers you see in this region versus the US and Europe, for example?
We always had a keen interest to invest across the globe. And in Asia, you basically have two major pockets in our segment. We are, as you know, more innovation-focused, biotech-focused. We have a very strong science base in China. And we have benefited from that through both fund investments, where we go with some of the best innovation managers, and of course, direct investments, which we source either directly or through such funds. But we benefit from the top-notch science that is being developed in China. Recently, of course, you had a bit of a rough patch in general because of the equity markets, which were really in the winter period, I would call it. But the government is stimulating, and so hopefully that will also reflect in some higher share prices. But in general, we've been very happy with our investments in China. India, on the other hand, is another really very exciting investment country for us, and the majority there is domestic brand developers with the strong growth. Then, of course, the so-called CDMOs, which are companies that work, on the innovation side, both from a manufacturing or also a discovery side for new drugs. And then, of course, you have the whole generics pot, which is, very important for the global north to really bring cheap, high-quality APIs and formulations to the markets. And India plays a key role in that. And so I've experienced over the last 20 years, many companies who were set up with a 50 million market cap, and today they're 8 billion, 10 billion, 15 billion. So we've seen massive value creation in India, and we have benefited from some of that for our investors. So Asia will remain, certainly an important element for our strategy, and it differentiates us to a degree from the traditional biotech investors who mainly invest in the US and to a lesser degree in Europe.
Okay, that's great. Your portfolio is heavily focused on biotech. Why is that? And what are some of the key therapeutic areas within the space which offer the best prospects for the future, according to you?
Traditionally, high science and great innovation is, of course, the biggest value creator within healthcare. And it's not without risk, but if you have a good portfolio and you balance your risk, you generally can achieve high returns with innovative investment in that space. And that's what we're doing. So we have obviously other segments, as I just mentioned, which can contribute good earnings, but the last 20 years, at least, the innovation segment of biotech was highly rewarding, which you see, of course, even if you just look at some of the indices like the Nasdaq Biotech Index or the XBI, which had a really good, double-digit returns over a 20-year period in US dollars. So for us, it's a segment which we can still benefit from, and that's why we're currently still investing into those segments the most. Obviously, if we look out what happens in the next 10 to 20 years, maybe there are some changes, but for the time being, we're happy with that sector and segment.
Okay. And that takes us to our next question. Outside of biotech, where do you see the most significant opportunities?
We obviously screen the universe, and there's some interesting companies in the diagnostic space. We have a couple in our portfolio as well. Occasionally, there's some great development in medtech. We have a few medtech investments as well, and I think both of these segments will go on. So we will, do our best to look outside. As I mentioned, one element that excites us to a degree is the whole contract development manufacturing space, the so-called CDMO space, because outsourcing is a key element for the industry. So there we see good growth for the next years with some of the smaller players, and there's certainly new initiatives where we've had a foot in as well, like digital health. There's some interesting digital health initiatives, being it on a smaller scale with certain apps, being it on a bigger scales with the online pharmacies that have been a subject where we have played a role. So we always find attractive new niches where we look at. The latest, of course, is AI and its role in drug development or in monitoring clinical trials and patient recruitment. So we have right now not really invested into that space, but we are observing it and see who could be a champion or who would be a contributor to value creation. What I didn't mention before, I forgot to tell, you asked also about the what indications or what areas excite us. So obviously, oncology is, of course, a very broad investment theme for everybody in biotech. I think an increasing bigger pie is also for immunology, and then to a degree also the whole neurological science space. So we will probably find some good assets in those areas that create value for our shareholders.
Big Pharma is facing a patent cliff with over $200 billion of sales at risk by 2030. What are your thoughts on that, and how important do you think M&A will be as a growth driver for the sector? And how does your portfolio leverage this opportunity?
Yes, let's start with the pharma and where they really get their new products and innovation. So the last 10 years, there was a very clear shift that the majority of the innovation or the new revenues of pharma are actually sourced from the outside. And there's two ways for them to source that. One is, do license deals, which they can do in any stage of the development of drugs. So that's a very popular one, where also you have some risk sharing, of course, with the innovator companies, the younger companies. On the other hand, there is M&A. M&A will play a role, but one should not overemphasize on the M&A. There's on the total universe of biotech companies, the M&A is always a smaller fragment or a smaller percentage of the whole. But it's clear it is important to add revenues or good products to the pipelines of large pharma. So we are well positioned, of course, in that, as when we make investments, we really look for top innovation, for differentiated assets that can create value by bringing in revenues in the marketplace with the right marketing and sales organization, which is often a big pharma. So we have a clear focus on what could be potential M&As, because that will ultimately be the value drivers also for our best companies in the portfolio.
The Fed recently cut its interest rates by 50 basis points. How significant do you think this is for the healthcare space in general? And how do you see this impacting overall activity in the sector, particularly in terms of IPOs and M&A activity?
Obviously, lower interest rates generally have a, increasing of risk appetite for investors, which will trickle down or dribble down, whatever you call it, down to even the biotech investing. So some of the investors that are more on the generalist front will maybe take some opportunity by either investing maybe in some indices or some ETFs or direct investments into some of our, smaller names in the segment. So I think it could have a benefit for us healthcare specialists, that we see some money inflows. And we experienced some of that in the recent weeks already, since the Fed cut its rate the first time. So that's probably going on. I'm always on the more conservative side, and I'm not expecting dramatic inflows and all of a sudden exuberance again in our market. And that's why we need to look for real value creation from the innovation side. So we'll see how that develops over the next months and years to come.
That's great. Thanks a lot, Andreas, for this insightful discussion. We look forward to following the progress of the company in the future. Thank you again for your time today.
Thank you very much again for hosting me, and have a good day. Bye.
You too.